Okay guys, welcome to the next part of this chapter. This chapter will be looking at the risk and the money management. Perhaps one of the most important parts of your trading is being able to determine the amount of risk that you're going to take and how you're going to manage your money. Okay, now when it comes to risk appetite, people's appetite for risk, risk profiles, everyone is different. Okay, it depends on many factors. We've already discussed this, but things such as age, your income, the amount of disposable income that you have, the amount of liabilities that you have, all these factors combined will develop your appetite for risk or your risk profile. Okay. Now, when it comes to trading, a simple calculation can be used to determine the amount of risk that you're going to take per trade. Okay. This is normally based on the account value. So first things first, how do we determine the amount of deposits that you're going to place into your account? Okay, now again, this will differ from person to person, again depending on the amount of disposable income that you have, the amount of outgoings that you have, what your income is, what you have coming in and what you have going out. Okay, so this will differ from person to person. Now, ideally, a good starting point is £1,000 if you can do this, or if you can't, then that's totally fine. Starting a little bit less is totally fine as well. But as with any other investment, the general rule here is to be comfortable with the amount of money that you're investing or risking. Okay guys, now that we've decided on the amount that we're going to deposit into the trading account itself, we now need to decide upon the risk that you're willing to take per trade. Now, typically the more risk-averse traders, that's traders that don't like taking too much risk, they will typically risk between 1 to 2% of their account value. Now, in essence, what they're doing is safeguarding and protecting their capital, because if you look at the bigger picture, they would have to get 50 to 100 trades wrong completely in a row to completely blow their account. Now, the more riskier traders, they were willing to take between 3 to 5% risk per trade, and that's because risk and reward goes hand in hand. Now, if they want bigger rewards, they have to take on bigger risk. So, if you look at the 3 to 5% trader, they would only have to get 20 to 30 trades wrong in a row for them to completely blow their account. So obviously there is more risk, as opposed to 50 to 100 with the more risk-averse trader if you're typically risking between 1 to 2% of your account value. Okay guys, now whether you've decided to be a risk-averse trader, risking only 1 to 2% of your account value, or you're a riskier trader, risking between 3 to 5% of your account value, the calculation remains the same regardless. Okay, now let me show you an example of this. So say we have opened the account, we've deposited £1,000 into this account. Now every trade that you're placing, you're going to be risking 5%, okay, because you're a more riskier trader. Now 5% of £1,000 is £50, okay, so that would be your risk per trade. Now say you were to trade for a month and you managed to grow this account value up to £1,500, the percentage will still remain the same. Okay, so now you'll be risking 5% of 1,500, which is £75. Okay, now say a few months down the line, you manage to grow this account all the way up to £10,000. Okay, the calculation again remains the same. So now you have an account value of £10,000. 5% of 10,000 now becomes £500. So as you can see, as your account grows and compounds, now the risk per trade also increases in line with your account value. Okay. Now the rewards with this will also increase in line with your risk, but you just have to bear in mind, no matter what your account value gets to, you use the same calculation. Okay guys, now I've just shown you an example of someone compounding their account. Okay, so they've eventually grown their account from £1,000 to £1,500 and eventually reaching £10,000. Now, not every trader likes to trade in this way. A lot of traders like to withdraw some of their profits to treat themselves, whether that's to pay for some bills, pay for some clothes, go on holiday, whatever it may be. Now, some traders and some traders see this to be a smart way of managing your money, they will take out their initial investment. So for example, if you started with £1,000 and you grew that to £5,000, they will take out their initial investment of £1,000 and leave the £4,000 in there to compound and grow. Okay, now it doesn't matter what you do, compounding or withdrawals, that's totally up to you. There's no right or wrong way of doing this. It comes down to personal preference, and you yourself will have to decide on what's best for you. Okay guys, now when it comes to risk and money management, you may have heard of people blowing their account completely and losing absolutely everything that was in their account. Now I have to stress, this only comes from reckless trading, oversizing your positions, taking on way too much risk, not conducting thorough analysis. These types of things, the common mistakes to avoid, which we'll cover later in this chapter. People making these mistakes are the reason why they will blow their account. Okay, but if you stay disciplined and committed to your trading, there is no reason why you would ever need to worry about losing large amounts of money. Now, I'd like to expand on this a little further. Okay, so it's people that don't take trading too seriously. They jump into trading the markets, into the deep end straight away without looking into what trading actually is, taking courses such as this. They jump straight into the deep end and think the markets are a joke. Okay, so buying and selling is the same as betting red or black in a casino. Now that is far from the truth. As we know, a lot of analysis, a lot of commitment and dedication goes into our trading, and it's more a calculated risk that we take as opposed to gambling in a casino. Okay guys, now I want to expand on risk and money management a little bit further, and why you should never have to worry about losing too much money or blowing your account completely. Now, if you're following the right to risk parameters that we've set out for you, the right to risk percentage per trade, the right to risk reward ratios, then you should never have to worry about losing too much money. Okay, now let me put this in practice. So when we're placing a trade, we want to look for trades that have a risk reward ratio of 1 to 1. So let me try and explain this. So when we're looking at risk reward, we want to have a risk ratio of 1 to 1, which basically means if you're risking $100, you want to make at least $100 profit. Now, if a risk reward ratio is 1 to say 0.7, we want to leave that trade alone, because the reward here would only be $70 for $100 risk. Now, you want to leave those trades alone. You want to let the trades come to you. That's discipline and not chasing trades. Okay, now if you follow this risk reward, you have $100 to $100, that's the minimum that you want to take on. Sometimes you'll have a risk reward ratio greater than this, so maybe 1 to 1.3 for example, and here you will make $130. Okay? Anything less than that, anything less than 1 to 1, you want to leave alone completely. Now if you're following this, and say you place 50 trades, okay? You have 50 trades in a month, and you have a win percentage of 70%. Now that would be 35 trades that you get correct, which will equate to, say if you're still following this, $100, that would equate to $3,500. So if you've got 35 out of 50 trades right, you will have 15 trades that you have got wrong. Now that will equate to $1,500. Now, if you take away the profit away from the loss, as you can see here, you would have still made $2,000. Okay? Now, say if you are only getting 60% of your trades right. Okay? Now that would be 30 trades correct and 20 that you would have got wrong. Now, if you've got 30 correct, that would equate to a profit of $3,000. And a loss of $2,000. And even then, although you've got only 60% of them right, but because you've been following the right risk reward ratios, that would still equate to a profit of $1,000. Okay, so hopefully that proves the point that you don't need to be 100% correct all the time. You only need to be, say, even 60% right, and you still become a profitable trader. If and only if you're following the right risk reward and you're following the right risk parameters that we've set out for you. Again, following the risk percentage per trade rules, and not chasing trades that are not don't have a risk reward ratio at least 1 to 1. Okay, so if you're following this, now very profitable traders will have an accuracy percentage of say 80%. But like I said, even if you're getting 60% right, you can see that you're still making $1,000 profit on this example.